Hello and welcome to today's webinar. My name is DJ and I'm going to be in the background answering any WebEx technical questions. We do have a few housekeeping items to go over before we get started today. If you experience any technical difficulties joining the WebEx session, you can always dial 1-866-779-3239, or you can message the WebEx producer, myself, Donald Bates, using the Q&A panel. During the presentation, all participants will remain in listen-only mode, and as a reminder, this event is being recorded. You may ask a question at any time throughout today's event by entering it into the Q&A panel found in the bottom right-hand corner of your screen. If you do not see it, that's okay. You may have to select the three dots in the bottom right-hand corner. Once you select the three dots, you can choose Q&A from the drop-down menu, and it should appear on the right-hand side of your screen. Select the arrow next to Q&A to expand, type in your question, and hit submit. Please keep the drop-down set to all panelists so we can make sure to see your questions as you submit them. I'd now like to introduce your very first speaker for today, or your speaker for today, Nathaniel Inkman. Nathaniel, you now have the floor.
Hi, I'm Nathaniel Ekman. I'm an analyst here at Value Line and a member of our Value Line Select team. I'm joined today by two other senior analysts, Alan House and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then discuss our Value Line Select product and, finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. While the Value Line Investment Survey is our flagship product, it's far from our only one. At Value Line, we produce a wide variety of monthly periodicals and online services designed to meet the diverse needs of investors. Some, like our Dividend Income and Growth service, cater to particular investing styles, while others, like our Fund Advisor Plus service, cover other types of securities. The original, however, is Value Line Select, our premier stock picking service. Every month, Value Line Select subscribers receive an in-depth report on a single stock chosen from the entire Value Line universe of stocks, prepared with the greatest level of detail and analysis that we provide, explaining the company's position, risks, and our case to buy. Each report also includes updates on previous portfolio selections and our commentary on the state of the economy and stock market. Furthermore, unlike other such services, Value Line Select tells you not only when to buy, but also when to sell, with sell alerts issued by phone and email so that you're always up to date, even between reports. Our track record is strong. In 2024, we beat the S&P 500 by 166 basis points with a return of 24.96%. Value Line Select is available in both print and online-only editions. If you have any questions about the products or services we offer, or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. Value Line's economic staff prepared this content. The nation added an estimated 256,000 jobs in December. That figure far exceeded the consensus forecast of 155,000 and was 44,000 above the revised November tally. The gain included private sector growth of 231,000 positions, which speaks volumes about the quality of job creation activity and the overall health of the labor sector. In addition, the Job Openings and Labor Turnover Survey, or JOLTS, showed an uptick in the number of available positions last month. The inflation situation remains unresolved for the Federal Reserve. The much-anticipated December Consumer Price Index, or CPI, rose 0.4% and 2.9% on a month-to-month and one-year basis, respectively. The core CPI, which excludes the energy and food components, climbed 0.2% and 3.2%, respectively. In all, the report showed that the pace of price growth is still running above the Fed's target rate of 2%. However, Wall Street took some solace in the cooler core CPI reading. The companion Producer Price Index, or PPI, painted a similar picture, though both reports still indicate sticky inflation. Treasury yields are elevated, but did ease some on the December price data. The CPI report opens the door a bit for a few interest rate cuts this year. However, we don't think the Fed will be in a rush to do any further easing before mid-year. Also, a near-term reacceleration in inflation is possible and would likely place additional pressure on bond yields. With borrowing costs likely to remain elevated this year, profit growth will be needed to justify the stock market's rich price-to-earnings multiple. That said, with the economy on a better track than most pundits would have anticipated at this stage of the upcycle, and the Trump administration focused on pro-growth policies such as lower taxes and fewer regulations, further corporate gains in 2025 are plausible. The market has had a choppy start in 2025, although recently touching some new highs. There have been worries about inflation and a likely less dovish Federal Reserve with regard to monetary policy, unnerving investors. However, with the fixed income market also hurt by higher Treasury yields, a portfolio consisting mostly of high-quality companies with a history of generating steady earnings and cash flow growth may prove astute. Please refer to the inside back cover of Selection and Opinion in the Value Line Investment Survey for our statistically based asset allocation model's current reading. I will now show you how to use Value Line's Stock Screener, a powerful tool which our subscribers have access to. Through this demonstration, I will reveal the most recent addition to the Value Line Select portfolio. Once signed in on the Value Line website, head to the dashboard, where I am already located. This is the main landing page for subscribers, where you will find economic commentary, supplementary reports, and other up-to-date content. From there, we want to choose Browse Research and navigate to the screener. Although this screener is just one element of the selection process we use for services like Select, it's a very useful one, as it helps us sift through the thousands of equities in our database using targeted, relevant criteria, and it's one we're proud to make available for Investment Survey subscribers. When looking at stocks for the Select service, we want to focus on companies that are at least as safe as the average equity under our review. Hence, today we will focus on companies that are ranked 3 or better for safety. Keep in mind that our safety system ranks stocks from 1 to 5 based on their relative risk profile. After screening for this, we have whittled our list down to 2,164 stocks. Next, we'll filter for financial strength rating. This metric measures how financially sound a company is. When taken together with an average safety score, we are focusing on companies that are financially healthy with stocks that tend to be no riskier than the broader market averages. After screening for this variable, we have narrowed the list down to 977 stocks. We want to focus on stocks that are ranked to beat the performance of the broader market averages in the year ahead, so we will filter for a timeliness rank of 2 or better. After screening for this factor, we are down to 238 stocks. Finally, we want stocks with strong return potential. For this, we will filter for 18-month appreciation and 3 to 5 year annual returns of 20% each. This is substantially above the value line averages of 14% 18-month appreciation potential and 10.5% annual returns. So we'll take a moment to finish applying those screens, and then with those criteria applied, we now have a list of 9 companies, including our most recent addition to the select portfolio, Dell Technologies. Before we move on, please note that screens can be saved and revisited by creating the Create Saved Screen button at the top of the page. Now, if we click on Dell, we find the landing page for the stock and Value Line's digital report. If we care to, we can also click on PDF reports near the top right of the page to find the most recent full-page reports on the company from the investment survey. However, we're not here for that today. Instead, let's take a look at the latest issue of Value Line Select featuring Dell. So, opening up the Select report, starting on page 4, after our economist's note, you can see that our report begins with an easy-to-reference selection of important information about the company, including several of the criteria used in our screen. Beginning on the next page, the report proper begins. This includes detailed breakdowns of our projections and our case to buy, as well as an overview of the business's structure, strategy, and major risks. Next come tables of detailed financial data beginning on page 9. Finally, on page 10, we offer an up-to-date overview of the select portfolio, followed on the next page by updates on a few noteworthy past selections. As we note in the report, Dell Technologies is a leading global provider of computer hardware, software, and services. Through its Infrastructure Solutions Group reporting segment, which supplies servers, information storage systems, and networking equipment, Dell provides exposure to the rapidly growing artificial intelligence, or AI, infrastructure industry. The company has a significant position in the market for high-performance data center servers that power AI workloads, and may be picking up market share at the expense of rival Supermicrocomputer, which has had some well-documented troubles of late. While year-over-year consolidated revenue growth over the first 9 months of fiscal 2024 has come in at 8%, the Infrastructure Solutions Group, or ISG, segment has seen its top line expand by 31%. Servers and networking provided all of this ISG top line gain, with a 61% increase from $12.8 billion to $20.5 billion. Meanwhile, the company's other segment, the Client Solutions Group, or CSG, may be at or near a bottom in its cycle. There are several factors that mean a turnaround is likely in the near future. First, we're entering the upswing of the PC hardware refresh cycle, which should incentivize many, particularly those in computation-heavy industries, as well as video game enthusiasts, to upgrade to new machines. More significantly, however, Microsoft will be ending support for Windows 10 this coming October. While paid security updates will be available to those who need to continue using Windows 10, most people and organizations will likely upgrade, which in many cases will require new hardware capable of running Windows 11. Our analyst is projecting 7 to 8% annual top-line growth and 13 to 14% EPS growth on average for the 2023 to 2028 stretch. Given the strong growth in servers and networking that we expect will continue, and the turnaround potential at the CSG segment, we on the Select team think that there may be a somewhat more bullish picture to paint. Nevertheless, on the targets provided in the survey, the stock offers 75 to 80% 3 to 5 year upside potential at the midpoint of our $165 to $250 target price range, which is derived from applying a price earnings ratio of 16 times our projected 2028 earnings per share of $13. We will now tackle a few of your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. The first few questions were submitted prior to this presentation. I'll now hand it off to Alan and Charlie. Take it away, guys.
Thank you, Nathaniel. My name is Alan, and we had a very good question come in. What factors do you use when considering a stock for the Select portfolio? The managers of the Select fund begin by running various screens. The screens can change to an extent depending on what they feel is needed to bolster the current portfolio. Here are some qualitative and quantitative criteria that may be used. Stocks must be ranked at least 3 average for timeliness. They also look for stocks that have a greater return than the S&P 500 index over the trailing 1 and 3 year periods. They also look for catalysts that could drive the stock price higher in the months ahead. Positive earnings and revenue revisions are also a factor that's watched. They also consider equities with above average intermediate term appreciation potential, as indicated by worthwhile upside to the midpoint of Value Line's 18-month target price range. Overall, they're looking for GARP, which stands for growth at a reasonable price, targeting companies with solid top and bottom line gains prospects that are selling at reasonable relative valuations. Furthermore, they also look at investment themes based on strong secular trends. Finally, stocks with solid 3 to 5 year capital gains potential relative to the Value Line median are also considered. Thank you. There's actually another good question just came in. Please discuss the PE ratio in more detail and how it can be useful for investing. This is a very good question that gets asked from time to time. The price earnings ratio is the most widely used statistic in investing. If you're like most investors, you will not make a move without knowing the PE ratio of the companies whose stocks are on your short list. In addition, you will regularly check the PE ratios of the companies whose shares you own. The PE ratio is a measure of a company's market value relative to its earnings. In the most basic terms, a PE ratio is the price of a company's stock at the close of the previous trading day divided by its share earnings. Value Line calculates the PE by dividing a stock's current price by an earnings figure that includes 6 months of past earnings and 6 months of projected future earnings. For example, let's say a company has a share price of $40 and its earnings per share are $2. Its PE would be 20. If the company's earnings jump to 250 and its price remains constant, then the PE will be lowered to 16, which would be a more attractive scenario for many. There is no right or wrong PE. Expect to pay a higher price and accept a higher PE for companies whose earnings are accelerating. The opposite is true for companies whose earnings are flat or growing more slowly. If you believe that earnings are poised to take off before the market recognizes it, and the company is maintaining its current PE ratio, you might be more inclined to purchase the shares, or at least consider purchasing the shares in anticipation of a future earnings jump. In fact, depending on your tolerance for risk, you might be willing to pay a relatively high price for a stock with low or even no earnings in anticipation that it will be a standout moneymaker in the future. On the other hand, if an R analyst projects continuing growth for a company but the PE is already high, you may want to wait for a pullback in price before committing funds, so you do not pay more than you want based on the total return you anticipate. You also find trailing PE and 10-year median PE in our data. The trailing PE does not consider future earnings. It divides the stock's previous trading days closing by the most recent 12 months of actual earnings. So in a nutshell, the PE should be looked at on a case by case or at least on an industry basis. For some companies, a market PE could be considered high, whereas other companies, a market PE of 50, especially in a case of a tech company that has a lot of AI related presence, that could be relatively attractive valuation. So it should be looked at on a case by case basis. And there was another follow-up question related to the timeliness rank. How could a stock with a very high PE also have a high timeliness rank? And yes, that does happen sometimes because one of the factors in timeliness rank is the stock's price and earnings momentum. So if a stock has strong price and earnings momentum, even if it has a high PE ratio, it could still have a high timeliness rank. So that can absolutely be the case. It's not always the case, but it could absolutely be the case, based on our ranking system, because sometimes, there's a lot of momentum stocks out there that are they look pretty pricey, but they also have very strong earnings growth potential. So that has to be factored in as well. So thank
Uh-huh.
you.
Yeah. So speaking of timeliness, I've got a question here asking, is it too late to buy Nvidia? Now, as I said at the top, we can't really get into stuff with specific companies, but I can address some things about the AI market, and in particular the sort of AI infrastructure and hardware market, in which Dell is also a significant player, a bit more broadly. Now, the thing is, this is very challenging, and this is an area where where you're going to find a diversity of opinion from a lot of different well-qualified analysts, because a lot of what it comes down to is the market we're seeing for AI right now a bubble or not? And that is a divisive question. My personal view as an analyst is I would compare this in certain respects to the 1990s dot-com bubble. And there are a lot of reasons I could cite for why I see it that way, but maybe the most convincing is if you look at how this started. The current AI, cycle with the surging valuations and all of this, it started around November 2022 with the public release of OpenAI's ChatGPT platform. And that really kicked off a great deal of interest and investment in this area. But the thing is, nothing about that was actually new information. At that time, NVIDIA had already been the preferred technology platform for AI development for, 14, almost 15 years. So that wasn't new. The capabilities of machine learning models, those weren't new. You had very convincing demonstrations of this technology going back to, 2018, 2019. So none of it was new. But the thing that you had was this very public demonstration of a capability that we as humans are inclined to find very impressive. And if you want more detail on this, we just ran an article on this in the investment surveys selection and opinion section. But we as humans, we're very well evolved to evaluate other humans socially to the extent that we will actually do this where it's not appropriate, like with assigning human motivations to animals. I'm sure you've done this. Like you've looked at an animal and you've seen it do something and you've attributed a human reason to it doing that isn't necessarily applicable because we're talking about an animal. And similarly, suddenly you have this AI that can talk like a human. We're very, very inclined to see that and go, oh, wow, this is amazing. And to me, the fact that that is what kicked off the current cycle of interest in AI and not, again, the information that's been available for years and years, to me, that tells me that maybe the market isn't behaving rationally when it comes to AI. However, I want to put a big caveat on this with regards to AI hardware companies, the companies doing the infrastructure like NVIDIA and like Dell, because this is something we saw with the dot-com bubble as well. When the bubble burst, everyone took a hit, but eventually some of the companies that rose from that were the infrastructure companies like Amazon, for example, is one of the big 90s internet companies that was around for the dot-com bubble. It took a bit of a hit when the bubble burst, but I mean, look at it now. And a lot of that comes down to when you think of Amazon, obviously you have the storefront, but you also have the infrastructure end of Amazon Web Services that supports an absolutely massive amount of the internet. And so similarly with AI, my view is that we are likely going to see a bit of a crash. We're going to see some impact across the board, and that is going to hit companies like NVIDIA. However, I think that those infrastructural, those hardware companies are ultimately going to recover very nicely from that and go on to continue to be hugely important because this technology is not going away. It's just that some people don't fully understand what its applicability is going to look like yet, and they're maybe making decisions about their investment based on an emotional reaction rather than a considered view of what the technology is capable of. Um, but because of that, because the market may not be behaving rationally, it's pretty much impossible to say when that sort of dip might occur. So is it too late to buy into this? I would say probably not, but it's very difficult to say that. Um, so if we don't have any other questions, I think I'm going to kick it back to DJ to close us out.
Thank you, everyone, for joining today's session. Attendees at this time, you may now disconnect and have a wonderful rest of your day.